Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. The Reserve Bank of India earlier today warned of a surge in inflation in July and the current month of August due to costlier vegetables, and as a consequence has revised upwards its inflation estimate for the year by as much as 30 basis points. Thankfully, the central bank has not raised interest rates. It has kept the repo rate at pause and it has indicated that it will remain focused on the withdrawal of accommodation and is ready to act if required. The RBI Governor Shaktikanta Das in his statement today also acknowledged the role of tomatoes in the current inflation surge. Let us first listen into what he had to say, some of the key highlights.
Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6%, 6.5%. It's 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate stand at 6.75%. Headline inflation, after reaching a low of 4.3% in May 2023, rose in June and is expected to surge during July-August, led by vegetable prices. While the vegetable price shock may reverse quickly, possible El Nino weather conditions along with global food prices need to be watched closely, with the objective of harnessing new technologies for enhancing the digital payments experience for users. It is proposed to, number one, enable conversational payments on UPI, which will enable the users to engage in conversation with artificial intelligence powered systems to make payments.
Well, that was the RBI Governor, and joining me now to discuss and decode what the RBI has really done and what it means going forward for interest rates and broader indications for the economy, Ashutosh Khajuria, the Executive Director at the Federal Bank. We are also joined by Madan, the Chief Economist at the Bank of Baroda. I come to you, Madan, as the macro person on the panel first to kind of sum it up. A warning delivered today with a hint of softness, warning shots really fired today due to inflation. Madan, is that the right way to describe the policy statement overall?
Yeah, I think that did come as a major surprise to us. And the way I look at the policy on the whole is that it is slightly hawkish. It's being hawkish without being overtly hawkish. So I think they have left the repo rate unchanged. But the way I interpret the combination of the revised inflation forecast along with the fact that you brought in this incremental CRR, it means really that the RBI is not really comfortable with the current situation. And while they would have liked to have increased the repo rate, they have not done it because they think that inflation will probably come below the 6% marks after August. And it's only the tomato effect which has led to this kind of inflation. But I've also mentioned somewhere along the way that in case it's required to increase the rates, they will actually not hesitate to increase the rates. That is meaning thereby that if inflation remains above 6% over a prolonged period of time, like what we saw last year, there would definitely be a possibility also of an increase in rates. This actually shuts the door for any kind of an interest rate reduction in the current financial year. Earlier, we thought that maybe in February or so, it was possible that the rates could be lowered. But now it looks like that if at all there's going to be any kind of a lowering of the repo rate, it'll happen only in the new financial year. So that would be my major takeaway from it.
That's a good summary. The door had opened and those who were hoping for a rate cut had their feet inside the door, and Madan Sabnavis describes it as the door being shut. Mr. Khajuria, we always talk about hawks and a hawkish stance in a way when we discuss the monetary policy. Was there anything dovish in this policy that can give us comfort that money is not likely to get costlier in the near term?
No, I think I don't see any dovish so-called statement there. But one thing is very clear: this is another way of, tightening the rates and all. Because once you take away the liquidity off, then I think ultimately, and it's not just taking the liquidity off through your routine LAF operations, which is the liquidity adjustment facility.
Yes.
Because he made a mention of the variable reverse repo rate option getting a lukewarm response. So had banks, aggressively participated in that and in a 14 days variable reverse repo option, probably this problem in 2 fortnights could have been taken care of, 14 into 2. But I think because the banks did not probably have that comfort or that confidence that this liquidity to part with and keep with central bank for 14 days would be a good option. They went in for a lesser remunerative 1 day, 3 day type of standing deposit facility, which is at 6.25%. So ultimately, what has now happened is there is a cost to the bank rather than getting some return on the surplus liquidity placed with central bank. Now there is a cost. This money goes to, it's literally impounded. And for the system as a whole, this is not a small amount, 1.1 trillion, 1,10,000 crores. And the cost to the banking system would be of the order of somewhere around 800 to 900 crores. So I think this would lead to probably, at least for the fresh underwriting, a higher cost to the borrowers. Banks would like to, set off some of this cost through increased rates of interest.
So, Mr. Khajuria, taking your last comment forward, is this tightening through stealth an indirect move rather than a direct one?
The difference is that if it would have been a repo rate hike, then probably it would have more permanence in it. And here it is temporary, it is for 2 fortnights, 28 days. So I think, and sufficient liquidity has been promised for the festival season. So as we move into September, probably either on, from 8th of September or even before that, there would be review of it. And if that happens, probably this is a one-time temporary cost. So maybe I think this is something which, banks will have to take a call on whether to pass it on to borrowers or absorb it. If it is passed on, then it is a sort of pseudo equivalent of a rate high, not in the same proportion.
Okay. Madan, I want you to come into this particular debate and allow me to ask this question to you. I was looking at the timing of the decision to withdraw 2000 rupee notes from circulation, the 23rd of May. We had one policy announcement a couple of weeks after that. The point I am trying to establish is that the withdrawal of the 2000 rupee note is a policy decision, extraordinary, one-off. Why the announcement now? The central bank obviously would have estimated and known how much liquidity was going to be deposited in the banks. Why now? I kind of find the timing, you could probably have done it earlier. Am I even correct in asking that question, Madan?
No, I think it's a pertinent question. The thing is that when the 2000 rupee note was withdrawn, it was not actually quite sure as to how much of it would go into deposits and how much would be exchanged. And I think there was probably a case of saying that it could be maybe 50% exchange, 50% going into deposits. Now, I think the information which has come so far, what has been revealed by the RBI is that a large part of it, that is over 85%, is actually going back in the form of deposits. So this is what's led to this surplus liquidity situation. Now, I think the RBI has, I think what Mr. Khajuria mentioned is perfectly about, I would go along with that, perfectly right, that the RBI has been having these 14 days triple VR auctions, and the response has been very, very limited. because I don't think banks did have a bad time in 2022, because I do recollect there were times when they did go in for this 14-day triple VR, and then at some point of time you realize that there's a shortage of liquidity. RBI had to intervene through the repo window, and then you had the VRR which came in order to assuage the overall market. So to avoid these kind of situations, banks have not been putting the money for long tenures. Now I would have thought that the RBI could have probably discontinued the 14 days and kept moving around with the 3 or 4 days triple VRR, so that you're able to absorb the funds. And now actually what's really happened is that instead of getting a minimum of the 6.25% on the SDF, banks get hurt because you get nothing on it. And as Mr. Khajuria said, this is going to lead to an increase in the cost of funds, and that's going to be passed on to a certain extent to the borrower. So I think probably the RBI might have had this as at the back of the mind, but I think the main thing is that they wanted to tighten the market. So instead of increasing the repo rate, which would have been a permanent measure, you do it in an indirect manner. And I think this will probably serve the purpose. And they're keeping it for 1 month. Maybe, again, the RBI has not been very clear whether they're going to reverse it on 8th or whether they have to wait for the next policy. I think that's a prerogative of the RBI. And I have a feeling that this may carry on till probably the October policy, when they would be reversing it. But that's a time when the busy season typically starts.
Madan, a macro question before I go back to Mr. Khajuria, and I am reading from some commentary that has been shared today post the RBI decision. The CRR as an instrument of active liquidity management is expensive to administer, and using reserve requirements to fine tune the money supply is like trying to use a jackhammer to cut a diamond. Said by Mishkin in 1997. It's high economics, but demystify it for us, because the point I want to continue to push with you is these extraordinary one-offs and then the responses and the utilization of the CRR in some ways disrupt the normal flow. We had certain guidance, certain clarity of what the RBI was going to do a few quarters back. The RBI was earlier accused of waking up late to the inflation threat. Inflation is transient, it is concentrated in vegetables, which is seasonal, nothing unusual about it, yet a self-created thing, and this cost being imposed on the eventual consumer. Madan.
No, I think the way I look at it is that RBI is looking at it as a temporary measure. Now, you're right that theoretically, any
so why not wait it out? I'm sorry to interrupt you. So why not wait it out? It is temporary. So why not temporarily pause and wait for at least the completion of the deposit window in September?
No, I think more than 85 or 87% of these notes have actually come back already. So it's virtually, we know as to how much of money has come in the form of deposits, or what will be the final number. So I think what the RBI is doing is that tightening things for a temporary period during which time inflation is expected to be high. So therefore, I think with inflation being high in July and August, it will make, the RBI will probably get this information on inflation on September 12th. So therefore, it will be, October will probably be the right time for the RBI to probably go back on this particular measure. Theoretically, of course, what you started off with, Siddharth, was whether it's an efficient measure. Yeah, quantitative measures are always inefficient. Market measures, interest rates are obviously more effective. But it would have been slightly more odd in case they increased the repo rate now and then reversed it after 2 months. So I think that's the new approach which they have taken. So I think there are different ways of tackling monetary policy, and I think that's what the RBI has been talking even in the past. It's not just a conventional repo rate increase or decrease. You also have this new measure of bringing in the CRR. So I think they brought it in even during a demonetization time. I think that was the last time when the incremental CRR came, when the amount of resources with banks really went up. But I think one could have also taken the decision of saying, let's wait for two more weeks, and in fact, for the RBI, absorbing it through the variable reserve, the variable reserve ratio auctions was also an option, and the cost doesn't really matter. But I think it's more of a case of signaling, which the RBI has done through this measure.
Signaling, and on that note, I want to bring in Siddhartha Sanyal, Chief Economist at Bandhan Bank. Siddharth, we've been debating the fact that there is no rate hike, thankfully, but the key point about using the CRR and the decision that was announced of an incremental CRR of 10% to absorb surplus liquidity, where do you stand on this measure? Something that we should have anticipated, or the RBI now making up for perhaps some lost time in this regard?
Well, Siddharth, I think that's a very pertinent point. If I see the rate action was absolutely on expected line, the RBI's guidance had very much been on expected line. I don't think too many people really anticipated this CRR or incremental CRR move that the RBI has delivered. But I think one particular issue is that while quantum instruments are typically very blunt, immediate, as Madan has been highlighting, it's not really a market-driven instrument. But one particular thing is that if the current sharp surge in inflation you believe to be transient, this will be some kind of a matching move against that for a temporary period of time. So the RBI clearly remains focused on absorbing the excess liquidity that has come due to the 2000 rupee note related measure. But at the same time, some kind of an externality or some kind of a byproduct of this particular move is also to put forward a temporary measure against a presumably transient nature of inflation. Having said that, the RBI has made it pretty clear and amply clear that if by the time it's the October policy in another 8 weeks roughly down the line, if the situation is not improving, then RBI might not be hesitating to move further.
Uh, Ashutosh Khajuria, I'm coming back to you, and one quick follow-up on this point before we move on to other subjects. Should we be relieved, therefore? Should we be relieved, therefore, that this has not become a permanent measure and is temporary?
See, this statistical tool, quantitative tool, I would call it, CRR, is a very crude type of tool, but works immediately. I mean, something like a steroid and all. So from day after tomorrow itself, the cost would be incurred by the banking system. Whereas, when you have the rate action, it takes its own time for transmission. Now you have the external, benchmark linked loans or so. But there is a reset frequency. This frequency could be monthly, quarterly, or on the anniversary of the loan, and all those things are there. So depending upon the terms and conditions, even if it is an external benchmark or so, it takes some time. Whereas in case of CRI, it's immediate. Now, your question that you had posed to Madanji was more about, knowing about whether the currency notes would be coming in the system and therefore a good chunk of this could remain in deposits. Why is it that it was not foreseen and all that? The fact of the matter is, nobody expected this, vegetable price shock to come the way it has. You have seasonal challenges on the, food prices and all, particularly vegetable and fruit prices. But it was too sharp. I think some action was warranted. Thing is, the liquidity could have been absorbed through variable reverse repo rate. Even if there was a lukewarm response for maybe 14 days auctions or so, it could have been done for 7 days, or maybe 3 days auctions could have been repeated. That's one view. The other one was immediately, taking it off and, imposing some sort of cost on the banking system. Banks as an industry are doing fairly well as far as, you can say the cycle is concerned or so. So probably I think central bank would have thought that this is the right time, maybe they can absorb this type of cost and move on. So let's see. I think I still am quite sanguine that by 8th September or so, if the price situation, particularly on the non-core items or so, doesn't improve, then it could be reversed.
Mr. Khajuria, do you see banks like yourself and perhaps others needing to respond to this measure, or will, like you said, you will take the hit and move on because this is a temporary hit?
The fact of the matter is, every time many such policy announcements happen, we go back to the drawing board. Every bank has its ALCO. It would be debated with more of statistics, more of data, and that data would be analyzed as to what exactly needs to be done. And depending on that, banks may take measures. Almost 50% of the loan portfolio for most banks would be EBR linked also. So if it is external benchmark linked and repo doesn't change, probably there would be very little scope for banks to increase for the remaining 50%, or the new underwriting or so, the spread over external benchmark could be the factor on which the LCOs will have to debate what type of spreads to keep.
Fair point. Now, let me come back to the macro debate. And Madan, the question is that the RBI has also, if we sort of sum up the entire policy and whatever was said on the rate front, it's also indicated, which it has done earlier as well, that it is willing to see through temporary inflation spikes which are driven by items like vegetables, not really amenable to a monetary policy instrument of any form, and therefore willing to give growth a chance. How do you read the overall growth commentary from the central bank today, including the number that they have mentioned for GDP growth?
In fact, I think the premise of this entire credit policy is that economy is doing very well, not just in terms of this growth of 6.5%, but also relative to how other countries are performing. So therefore, with growth being on a stable path, one need not really worry about tinkering with interest rates or any of the monetary policy instruments in order to preserve growth. So we just go back to 2020. At that time, the RBI took the stance that we'll do everything in order to protect growth. But now, if growth is protected, and quite ironically, I think it has been stated that notwithstanding the fact that interest rates have gone up, growth has not been affected. There's an irony out there, because monetary policy is supposed to slow down the growth process. But here we have seen that growth hasn't really slowed down. It hasn't really been impeded in any significant manner. Now the RBI has the confidence of saying that, look, growth is on target, so therefore I can start attacking inflation. Now, whenever we get into this business of saying that monetary policy cannot affect prices of vegetables, that's fine. But the mandate is that you're targeting the headline number. Now, what goes into the headline number can be an explanation, but the decision has to be taken based on the headline number. So if the RBI is expecting it to be 6.2% Q2, 5.7% Q3, I think you will have to hold the reins. You'll have to tighten up the things in the economy, and that's exactly what they've done. It's a novel way of doing it, but it's some very strong signaling mechanism being sent. And just remember one thing, Siddharth, that they're not sucking out liquidity permanently, which would have been done through let's say through something like an open market operation, because that was always another option there. You say 1 lakh of securities are going to be sold to the banks, and I'm able to take out 1 lakh crores, but I'm not doing that. And giving a timeline by saying that we're going to review it in a month, there is, of course, a case of saying that this is only a temporary measure, not a permanent one.
A follow-up to what you said. Describe for the layman the reason that we are continuing to grow despite costlier capital.
Okay, the answer is very simple. When the interest rates went down to 4%, the repo rate, I think it was an abnormal situation. We were mispricing capital, and we mispriced capital. We gave capital cheap. We gave free money to people, primarily in order to protect the economy. Today, I can say is that the repo rate actually ideally should be around 6% in ideal conditions, when we have an inflation of around 5%, which is the average in the country. So therefore, by bringing about this correction, you have actually corrected a distortion. You have not really come in the way of growth. Because finally, even as a company which is going in for investment, I keep looking at the real interest rate all the time. And today I would say the capital is being priced in a better manner than what it was 2 years back.
Mr. Khajuria, the coming festive season, and I'm moving away from today and trying to get you to say something good for the average consumer. How will this season pan out at the broader corporate level? People are already talking about India shining, and I don't mean it with any negative connotation. But for the average consumer, what can he expect in this festive season? Are there going to be some offers, bank-led offers? Will they be able to sort of go out and buy, or will it be a tight-fisted approach from producers and lenders?
No, I think definitely as far as lenders are concerned, there are going to be lots of offers and campaigns going on. And the reason is, I think, the growth cycle is on upswing, and as Mr. Madan was sharing, I think despite capital becoming costlier, the growth rates are keeping up. And if you would have seen when interest rates were rock bottom, growth was not happening at that time, because what is required is more of a confidence and some sort of security for people to take risks and all. So now with despite capital being or finance cost being little higher for the producers and all, they are seeing the PMI numbers, which are more on survey basis and both on manufacturing side as well as on services side, are quite robust, particularly for India. And that suggests that there is some sort of confidence in the risk takers, and they are ready to pay higher finance costs to deliver, to manufacture more, meet the demand. And on the other side, consumers also are now, I think, moving from, accumulating everything in their bank deposits to really spending. And this can be seen, where else you will have the proof then in travel and, tourism and all. I belong to Jammu and Kashmir, and the type of, flow there of tourists suggests, it's more, that vengeance word is quite apt. It's more like a vengeance tourism and all that. People are compensating for what they were deprived of for last 2 years or so. So
Absolutely.
I think with that, people are ready to spend, and once people are ready to spend, these, finance cost and all would be a small share in their total cost of production.
Okay, that's a good point there. Madan, last half a minute on the show really, and your own number when it comes to inflation and GDP that you are working with now after today's announcement. Madan.
Yeah, in terms of inflation, see, earlier we were talking of a range of 5 to 5.5%. Now, based on the forecast which the RBI has given, which we would tend to agree for July and August, I think these numbers have come as a major surprise. I would say that inflation would be averaging 5.5% for the entire year. There is no change really in terms of the GDP growth rate. We're looking at something around 6.4%. And that's all based on this concept of normal monsoon. We'll have the statistical advantages of base effects for certain sectors which are there. But at the same time, I'm not too sanguine as the RBI in terms of the recovery of private sector investment. I think that's not going to be broad-based. It's going to be more restricted to infrastructure-related industries. I don't see too much of that happening in the consumer side unless there is a major revival in the third quarter. And for that, of course, we'll have to wait and see.
Absolutely. Madan, Sabnavis, Ashutosh, Khajuria, thank you very much for your time with us today for decoding the RBI's latest monetary policy announcement. Viewers, we'll come back with more. You got the broad message. Thankfully, one of the key actions by the central bank is temporary, and you can perhaps breathe a sigh of relief for the time being. With that, it's a wrap on this show. We'll be back with more. Till then, goodbye.
The next announcement, actually there are 3 announcements within this announcement, and it relates to UPI. And basically the announcements are related to bringing in conversational payments and offline capacity on the UPI, enhancement in transaction limit of small value offline digital payments. The details are as follows. With the objective of harnessing new technologies for enhancing the digital payments experience for users, it is proposed to, number 1, enable conversational payments on UPI, which will enable the users to engage in conversation with